All right, you guys, this is being recorded. One thing I say at the beginning of every single webinar is watch it again, because some of the nuances that I teach may be lost on you. Yeah, you can go out and figure out how to do a broken wing butterfly or any of these option strategies online. But one thing they will not be telling you guys is strike location and probabilities and how to increase those probabilities. They're just going to tell you specifically how to set it up. But there's certain scenarios you need to have in order to set up just about every single option strategy, as far as I'm concerned. And that's the way I teach it. There's certain scenarios for certain strategies, and we need to know what those scenarios are. So we'll talk about that a little bit more today. But this is advanced options, and it's on the broken wing butterfly. Now, broken wing butterfly isn't a super high risk strategy. It's a limited risk strategy. So we have that going for us. Okay. It's going to be defined risk, but because I have a lot of different rules in order to make this strategy work for us, we put this in the advanced category, because there's a lot of little technical things that go along with this that we need to have in order to implement a broken wing butterfly. All right, let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you may recognize me as a Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical market analysis. Started trading in college with a psychology degree, switched it over to finance about a year into it, started trading, sold all my stocks, jumped into the pits and started trading. I actually started out as a runner to get my feet wet, but then started trading relatively soon after that. One thing to go over here: any opinions, news, research, and analysis or other information contained here or material provided by Pro Trader Strategies should be considered general commentary and not constitute investment advice. At the end of the day, we're here to teach you guys how to swim. We're not here to swim for you. The reason why is because I don't know your risk parameters and I don't know what's in your portfolio. So what I'm talking about could be counterintuitive to what you're already doing. And past performance of any trading system or methodology is not necessarily indicative of future results. Also, I may be talking about stocks that I have positions in. That's not what I'm here to do. Try and pump and dump. I'm not doing that. All I'm doing is showing you this strategy in and around an underlying and an environment that is conducive for this strategy. Okay. You can also follow us on Twitter at Wolfman's Blog, or follow us at Pro Trader Strat. Coffee runner. Yes, I was a coffee runner, and go get gum and everything else when you're go sneak food on the floor and don't get caught. All right, so this is on the broken wing call butterfly. Okay, you can do this with the put butterfly, but we're going to be doing this specifically this week with the call butterfly. And it's also known as a skip strike butterfly or a wounded wing butterfly. We always call it broken wing butterfly. That's what I'll always refer to it as. The reason why it's called a skip strike butterfly is because literally we're skipping one strike on this butterfly. And really, that skip strike is what finances this whole entire strategy. And I'll talk about how that works out. But one thing we want to know is we want a market neutral strategy, because that's how we're going to get our max profit on this. Okay. I'd never reach for the max profit necessarily, but we want it to stay pretty close to where we're implementing this strategy in order to try and achieve that max profit. One thing that's beautiful about this strategy is there's no downside risk. So that's how I build it, is that there's no downside risk. Don't build this if there is downside risk. That means you would be doing this as a debit. You're increasing your risk on one end of this strategy. You need to be able to eliminate the downside on this strategy, okay? So when you're adding risk, you need to take away risk on the other side. We minimize some of it, but we still have risk to the downside. With this strategy, we want to build it so there's no risk to the downside if we are wrong. This is going to be a higher probability strategy than the long broken wing butterfly. It's a pretty high probability strategy. It's going to be about probably a 75% probability of success on this. And there's still risk in it, but we're minimizing a lot of the risk with this by adding some risk. All right. We're adding some risk to the upside, but we're taking away all of the risk to the downside. Right. Must have a market assumption. That market assumption is neutral, right? We want a neutral to bearish, if you will, market assumption. The way I build this out, you're going to have room to the upside, but really we want it to stay sideways to down. Down being, where we still get to keep that credit, but we want it to really stay where it currently is or end up where it currently is to collect that full credit we're looking for. So we want high implied volatility percent greater than 50. The reason why, the more volatility we have in this underlying, or that pumps up those premiums, allows us to get further away from where the underlying is trading. We'll get bigger credits. It'll also allow us to do this strategy for a slight credit, or at least unchanged, or no cost to us, if you will. But having said that, when you could implement this strategy in a low implied volatility percent environment, but keep in mind your wings are going to be very tight to where your short strikes are going to be, and you're not going to have a whole lot of room for error. When you have a lot of volatility, you're able to stretch it out a little bit and even increase your probabilities of success even further, Wally. You were asking about that a little bit earlier. All right, so the way we set this up, if you read this online, they're going to say buy one in the money call. I like to do this at the money. I like to do this to buy this as close to at the money as I can. It gives me a little room to the upside to be wrong, okay? I don't care if it goes to the south side or downside, I should say, because I've collected a credit. I'll be able to keep that credit if it goes down. All right. But we want to give ourselves a little bit of room to the upside. That's why I picked this one as the at the money call, or right there close to it. If you, like I said, you read it online, they're going to say in the money, out of the money, out of the money, or these might even be at the money. The way I build it, at the money is our first strike, then sell 2 out of the money, skip a strike, and then buy another out of the money call. Okay. And what happens is the skip strike, if you sold that strike out and then bought this further out, that's what actually finances this strategy. I'll go into that a little bit more detail here in a second, but keep that in mind. There's an embedded short call spread in here, and that embedded synthetic short call spread pays for this butterfly, okay? Like I said, I'll explain that a little bit better here in a minute. What deltas, I'll show you here in a second. We're going to be picking them. This one's going to be about a 50 delta. This one's probably going to be about a 30 something delta. And this one's probably going to be about a 10 delta. And that's just me picking the deltas off the top of my head, but give or take, you know what I'm saying? Yeah, I'll show the P&L curve also. Yes. All right. So that's how we set it up. Now, a traditional butterfly, you got to nail that number, right? When we built out those long call butterflies, you wanted to kind of nail on the number. With this one, it gives us a little bit of room for error. We also have a higher profit potential. We're going to be able to increase what our profit potential is because we have that whole downside, right? If we've eliminated all the downside and got a credit for doing this strategy, we have a higher profit potential, right? We have not only a higher profit potential if we nail the number, but we have a profit potential because we have so much room for movement, and it protects us from a downside move. All right. So keys to success, right environment. I mentioned this. We want high volatility in this underlying. All right. We need greater than an IV percent of 50. Now, when I talk about the IV percents, you guys, let's just take a look at Procter & Gamble here. This is where we come up with the IV percent. You take in the numerator and the denominator, right? Numerator, where the current IV is minus the low, and you divide that sum by the high minus the low. When that number comes out, we need that to be above 50. Right now, Procter & Gamble is probably pretty close. One thing we're going to have to worry about, almost all of these with high implied volatility right now is an earnings event. We do not want to implement this strategy this far in advance of an earnings event, okay? One, we're going to get increased volatility going into that event. Two, I would rather set this strategy up for an earnings trade right before the earnings. And I've got a deal for you guys on earnings later that we'll talk more about towards the end. I'm not specifically going to build this around earnings. For one, they're a little too far away right now. But two, I want to build this strategy for you guys for regular types of trades. Okay, but one thing we are going to have to worry about is this earnings event. I'm going to, in some of these, act like there's no earnings event, okay? So we can see what the strategy looks like without an earnings event. Even though it's in there, it's going to increase that volatility. It'll give us a good litmus test as to what it would look like if there were no earnings, okay? Please review. Yeah, Stuart, I'll go over it again. Implied volatility percent is, let me stretch this out for you guys. So in the numerator and the denominator, okay, so we have a fraction. You're going to let me stretch you out? All right. So in the numerator and the denominator, okay, so above, we take where the current IV is, which is 19. That's where it's currently at. And you subtract that by the low, which is right around 11. So in the numerator, we have 8. So 19 minus 11 is 8. And then you divide that sum by the sum of the high minus the low, which is 25 minus 11. So we have 14, right? So 8 divided by 14 is somewhere in the 60 percentile, right? So if we take that 8 divided by 14, it's going to be somewhere in the, yes, close to 60, okay? So that's above 50. That's how we figure out implied volatility percent. You need implied volatility where it is currently minus low, because every individual underlying, you guys, has a different implied volatility. We could look at Tesla, and Tesla is going to have a super high, you know, theirs is 60, but it doesn't necessarily mean that's at 100%. It still has its own implied volatility based on where it trades in the past. So it has a tendency to never even get as low as where Procter and Gamble is, okay? So what we need to make sure is that we are comparing apples to apples. And when you do this implied volatility percent, you're comparing apples to apples. You're comparing where this is now in comparison to where it's been in the past. We're not really too concerned about this number other than we know that this is a volatile underlying, right? Okay. Stuart's asking what, I'm just going to get rid of that one. What period of time do you use? Now, I use a full year. I have a lot of friends that trade and use 6 months. One thing I use a full year, just stay consistent. Choose what you like. If you like a shorter time period, you can use that 6 months. I have no problem with that, but stay consistent so that you can have data to lean back on, okay? Always keep track of everything, you guys. Write it down on a piece of paper, why you got into the trade, what trade environment was in and around that, what directionality, all of that stuff, and where you want to get out, so that you always have that down on a piece of paper in order to look back and see what your probabilities are and how this strategy is working out for you, or any strategy for that matter. You can figure out what your probabilities of success are and stuff like that, okay? Do you use IV percent on toss under the trade tab? I do use that as well, but a lot of people don't always have the think or swim. So, you know, I think what William's saying is right here. Think or swim gives you the IV percent. I actually have the IV percent over here. This is how important I think it is. I just look down here. I don't even care what the stock is and look for the first one that has no earnings, that has high implied volatility for this one. Okay. Some of these, like Twilio has earnings, Deere has earnings in there. So all of these actually have earnings in there. So I'm going to go through this strategy as if there was no earnings in them. Okay. So we can pretend that we can set this up in a situation like we would like, an environment where there's no earnings, has high implied volatility, those things, okay? Can we agree on that kind of little fib we're going to be telling ourselves without the earnings coming up? Good? Okay. Good enough. So yes, you can find the applied volatility percent. I have the code that you can put in here. They don't do that anymore, so I have the code. But what you're saying is we should use this before earnings, but few weeks before earnings. No, I'm saying do not do this a few weeks before earnings. I set all my strategies up for earnings right before the earnings, and I have a bunch of earnings webinars that are specifically tailored to trading those earnings, and I'll talk about those at the very end, okay? I'm not going to try and talk about those right now because I have some different rules with those, and I don't want to confuse everybody as we're going along here, okay? So we want to pick the right environment. High IV, anything above 50 is good. The higher the better because that allows us to get further away. A week before earnings? No, I do it a day before earnings, basically. All right, picking the right underlying. We need tight markets, you guys, especially if you guys are newer to trading. When I say picking the right underlying, we're looking at a stock under $100 right here. So my rule for a stock under $100 is the bid ask in the calls or the puts nearest to 45, 35 days to expiration is where most participation is. So that's where you want to look. We want these bid offers to be less than 10 cents or less wide. Any stock under $100. Any stock over $100, we want to move the decimal 3 ticks to the left, 1, 2, 3. So 14 cents wide would be our rule of thumb here. This is close to 30 cents wide right now. So that wouldn't necessarily meet the rule, but this one's 15 cents wide. So just kind of check a couple of them. EA Sports is not really fitting the bill here on that one. Okay. Netflix, move it 3 ticks to the left, $3 wide. Okay. So that's your rule of thumb for picking the right environment. And you can see Netflix fits that rule as well. It's quite a bit tighter than that. All right. All right, so picking the right underlying, tight bid ask. The more you trade a stock and you get in there and you're used to it and you know kind of like the markets, the more savvy you become as a trader in particular underlyings, then you can start bending that rule a little bit. But I would stay pretty hard fast to it. I mean, I've been trading for over 20 years and I try and stick to that rule like glue because I know there's nobody in there. And if there's the really wide bid ask, that means there's only a couple of traders in there and they're going to make you give up the edge. They know that they're the only trader in town. You've got to come to them. And if you have to give up that much edge to get in, you're probably going to have to give up that much edge to get out. And think about it. If you got 25 cents to give up to get in, 25 cents to get up to get out, you've gotten a 50-cent wide spread you got to deal with. So you got to at least make up 50 cents in order just to cover up that wiggle room that you're experiencing, okay? So make sure they're really tight so you don't have to give up that edge. Picking the right duration. With this one, the best I've found is less than 35 days, but that's because we've gotten this really steep slope here on theta decay, okay? We're right here around this 45 days. That's okay. 45 days to 35 days is good to implement any one of these broken wing butterflies. I just prefer to go inside of this 35 days to expiration, if at all possible. But, as long as you're inside of 45 days to expiration, that's a yellow light. Inside of 35 days, right at 35 days to expiration, that's the good green light to go for, all right? Right environment, the right environment is high implied volatility percent and as the no earnings event. Yes, and has no earnings event if you're going to set this up correct. Any special issues with using the broken wing butterfly trading the 10-year or the 30-year bond options? No, I have no problem with you trading bond options in and around using broken wing butterfly. Obviously, same rules apply. You want high implied volatility and you want to have a bearish assumption, which, right now with an increasing interest rate market, that may very well be a great strategy for this type of, can't really go up anymore, right? As far as I'm concerned, is I had added some negative deltas with this latest rally in the bonds as well. So yeah, I would definitely say this would be a good strategy for that. And we'll look at it. Just remind me. All right, picking the right strikes, you guys. This is where I'm talking about picking that one that is just right there at the money. I find that this is the best way to set this up for increasing our probabilities of success. And finally, knowing our exit strategy before entering the trade, I'm always looking to take about 50% of my max profit on this, okay, guys? And I'm going to probably risk it on the other end because it's the defined risk strategy, okay? Anytime I'm getting the defined risk strategy, I'm willing to lose that money going into it, okay? All right, so this is a normal broken wing butterfly when we set it up. We're going to be setting up a normal broken wing. This is an old example of Best Buy, but you can see we set this up where the underlying, we're doing the 41, 44, 47, okay? That's an equal distance butterfly. Now, if we sell this 47, and I know it's hard to see, you guys, 47 call, and then go out and buy the 50 call, right? Because this is $3 wide here, $3 wide here. So we want to skip this 7 strike and go $3 higher. So that would put us at the 50 strike. And what we do when we sell this 47 and buy the 50, we're selling. That's where I'm talking about. We're selling a synthetic short call spread that finances this. So you can see after that 47's gone, the 50's in there. We do this for a slight credit, which gives us no risk to the downside. Yes, we did increase our risk to the upside slightly, but we have a higher risk versus reward as well. And that's one thing we want to make sure of here is it's at least risk one to make one. Risk one to make one. So risking $300 in this particular underlying to make about $300. And that's all a product of the spreads that we'll talk about here right now. All right, so our max profit target is 50% of our max profit, and we're trying to risk one to make two when we set it up. So, if we risk $1 to make $2, we'd be trying to get out at $1, right? Or risk one, it's risk one to make one. Sorry, I don't know why I said risk one to make two. So if we're risking one to make one, we risk $1, we're trying to get out for 50 cents. Max profit is that middle strike, which is the one that we doubled on, the base of the body, the middle strike minus the lower strike. So that's the width of that spread. Remember, in our previous example, it was this, the width of this spread, the 41 to the 44, that's $3 wide. So $3 wide plus the credit we received, which was, in this case, 16 cents. So that $3 wide plus the 16 cents means our max profit is $3.16 to the upside. So in that case, we'd be trying to get out for about $1.55 or so, right? To make our max profit target, which is 50% of that, right? And our max loss is going to be that higher strike minus the skip strike minus the net credit. Same thing. It's still a $3 wide because remember we skipped that strike. That was a $3 wide. So $3 wide minus the credit we received. So $2.84, right? That $3 minus the 16 cents is $2.84 is our max loss. All right. And then our break evens on this is going to be that skip strike plus the credit. Because remember, we don't have any risk to the downside, so we don't have a break even. We don't have to worry about it. But our upside is that skip strike. So in this case, it's that 47 strike that we synthetically sold out of. That 47 strike plus the credit. So when the underlying trades up to 47.16, then that would be where our break even is met, 47.16. That's what that little line there is for, okay? All right, this is the part of the webinar where I throw it out to you guys. Let's go over some stuff. And we'll go through it step by step to see if it fits the rules. just throw out your stocks in that questions box that we've been going back and forth in, and we'll look at some different underlyings that we can do. And like I said, some of these I'm going to just forget about the earnings. Let's say Starbucks, we could say. So Starbucks has had a world of hurt since that whole fiasco of letting anyone in their stores. Just going to cost them, I think. So let's just say 40 some odd days. We don't have earnings. Yes, they do have earnings right in there, but we're going to pretend they don't. So we're going to start out with the at the money. The at the monies are about these $48 ones. So we can kind of flip back and forth on these. Let's just say we want a little room to the upside just to be safe. So we're going to buy that one, and then we are going to sell. So we're doing the 50s, and these are going to go skipping a couple. So let's just let's do the 50s, because see how they are skipping strikes funny here. So we're going to buy the 50s, sell the 52.5s twice, and then buy the 57.5s, and we can't do it for a credit. So it's not worth doing, right? There's no reason to increase our risk to the upside if we still have that risk to the downside. I'd rather just do this as a regular butterfly than the other. Let me just get rid of that. I don't know what that's from. So you can see we still have risk, so that wouldn't make it a good trade. So let's just try it, see if we can get the I'm not going to be able to probably get it very good with that one. So let's move on to another one. I don't think it's going to work out. I must review this video. Benu, yeah, everybody should really review this, because I'm talking about stuff that you're not going to find online. So it's not going to be easy to do. All right, so let's just go through this step by step. Nvidia is $200 stock, 3 ticks to the left, so 25 cents wide. Does this fit that rule, 25 cents wide? Yes, quite easily. We're fitting that rule, 25 cents wide. That works. Let's look at implied volatility percent, pretty low, 41. So that's pretty low. I'd rather have it be a little bit higher. You can see usually it's hanging out a little bit higher. So it's let's move on to another one. Somebody else said RCL. Royal Caribbean. So I haven't traded this one in quite a while. So let's look at it. $100 stock, move 3 ticks to the left, 10 cents wide. Looks like it's pretty good for 10 cents wide. You know, obviously check to see if there's earnings. There's no earnings. Yes, there is. I'm kidding. There's probably earnings right there, so it's going to land in our thing. But 43 implied volatility percent, still a little bit low. So let's move on to the next one. Gold. I'll do GLD as another one, or GLDE. GLD we'll look at. $100 stock, 3 ticks to the left, $11 wide, easily fits that. Implied volatility percent is 31. It's pretty low, but GLD is an ETF. So with my rule for ETFs, it's basically anything above 30. So when we're collecting those credits and stuff like that, just remember, if I say you need to be doing this in a stock above 50, if it's an ETF, I use it above 30, and vice versa. Below 50 for a stock on different strategies, that means below 30 for an ETF. That's pretty standard across the board, okay? So this is going to fit that if we wanted to look at it to the downside. As a broken wing butterfly, we're going to look at around the 19s. Those are the at the money, right? 05 to the 19s. So let's buy one of these. We're going to skip a couple because it's a $100 stock. At least $5. So let's go to the 24s and see if we can sell enough of those. I don't think we're going to. So it's probably going to still be a debit. All right. So we're not going to be able to do that. You can see I'm not going to be able to get a credit for this. So let's do that one and go. That's the 20. Let's try it again with the $3 wide. Sell 2 of those. Then that's $3 wide, so I got to go skip the $6. So the 6 is the one that we would normally be buying, right? So that's your regular butterfly, all right? That's a regular butterfly. We can look at it on the Analyze tab. So let's analyze the trade. And you can see equal distance, analyze the trade. We could get that. Now, this is what I was talking about. Let's pretend we sell the 6 calls. So we get out of those. We're acting like we sell those 6 calls and we buy the 9 calls. That's when you break that wing. See how we did that? That's that synthetic short call spread in there, creating that broken wing. Now, it didn't give us enough to eliminate the downside. So move on. There's other strategies we can use for gold for a neutral strategy that has high implied volatility and stuff like that. Okay. You know, you might want to do like an iron condor or a strangle, one of those other ones that we just did a webinar on for this strategy. It probably will work out a little bit better, okay? Trevor wants IBM. Let's look at IBM. All right, so let me delete this. What is that? IBM. Delete that one. So let's go into IBM and do this again. So we're going to try and go for the at the money, which is the 40s here. So we're going to buy those, sell the 45s twice, and then we're going to skip the 50s and go to the 55s, right? Still not giving us credit. Why aren't these working out for us? That one's not working. I was doing this all morning and everyone was working out. Let's try Twillo. Somebody was asking about Twillo. We're going to go 43 days. $50 stock, so it's got to be 10 cents wide. We've got that rule working out. High implied volatility works out. Duration, 40-some days to expiration. Closest to the at the money. I'm going to go a little bit higher here. Let's just see what we can do. Actually, I'm going to go here, sell 2 of those. So we've got $5 wide, and then go skip a strike and buy that one, okay? Again, if we wanted to look at this with that synthetic, we buy this, we sell 2 of those. That's your normal butterfly. Now, if I wanted to sell this 65, that gets rid of that and buy the 50s or buy the 70s. See how I did that? I really sold that synthetically a call spread in there, and I got that credit. All right. So I've eliminated, by getting that, you'll see on the Analyze tab, that I've eliminated that risk to the downside, right? I've eliminated all risk if this market moves to the downside. Now I've got $500 risk, $500 reward. It's pretty close. You know, it's a little bit less than 500 here and a little bit more than 500 there because of the actual credit, right? Do you have a max credit requirement? No, I will do this. The minimum credit requirement is 0. I don't have a max credit requirement. You can collect as much credit as you want, right? It's going to narrow this point down, okay, where you're going to narrow your reward potential because these are going to be slightly tighter, okay? And you'll probably be able to get a bigger credit for that. Right? Does that make sense? So does everybody get, I don't want to lose anybody on that synthetic short call spread. Does everybody get that, how I just did that? You know, the regular butterfly would have been the, what was the regular butterfly? So $5 wide, so it would have been the 65 strike. Right? That's your butterfly that people normally know as a butterfly. Limited risk on both sides. But then when I go in and I sell those 65s and buy the 70s, it creates that broken wing. Okay? Cool. And your exit is 50% of max profit. What is it for the loss? Well, I'm going to take this loss to the upside because it's defined risk, but I'm going to try and get out at 50% of my max profit, so $250, give or take, is where I'm going to be looking to get out. And I'm going to write that down, you guys. When I set this up, I'm going to be like, Twillo, I'm a little bit bearish. Maybe it's bumping up a resistance area or your Fibonacci's, I'm going to throw these up there dirty, but your Fibonacci's, you're like, okay, it's going to bang around in here for a while. No earnings coming out. It's going to be quiet. You know, that would be maybe your theory on your legs and stuff like that, okay? But for me, I'm going to look to take that max profit or max loss on the upside, you know, because if I get that correction back down, that's going to be a real quick max profit. You know, if it goes up above us and it stays up there and towards the end of, you know, let's say there's 10, 15 days left to expiration, it comes back down into that range, you're going to see it happen quickly. All right. Yes. General rule. If IV over, yes, IV, implied volatility percent over 50 for stocks and ETFs over 30, then you sell for a credit, correct. And if it's under 50 and under 30, then you buy for a debit, correct. Absolutely. The synthetic thing, okay, so I'll go over the synthetic thing real quick again, because it's a cool concept to think about, all right? Because this is your normal butterfly, right? Equal distance butterflies, okay? But what I do is I break this wing. So I'm going to, and when I set this up, okay, so I buy this one, I hold the control button down. You can see all these things light up. Control, I sell it twice. And then the butterfly, I buy it there. So that's your normal butterfly, okay? Equal distance. Now I break it by holding the control button down. I sell that option. See how I got rid of it? I sell that one. And then I go out and buy the further option. So then I buy that one. That's that broken wing. That's how you broke it. Yes, do not sell options when IV percent is below 50. Did that make sense for you, Marabella? You sell those 70s, you buy the 50s, and that's how it kind of goes, okay? Okay. All right, one last one I think is Costco. I think I saw in there. So Costco, let's take a look at it. Applied volatility percent is only 19. So that would be a strategy where you buy, which is what I did, right? If you watch the daily market commentaries, you know I took advantage of low implied volatility in Costco. All right. Trying to take advantage of expansion and volatility going forward into the earnings event. Okay. Do you have to set it up as a normal butterfly first and then break it, or can you just go directly to the broken butterfly on TOS platform? I go straight to the, you could, if you build it out this way, you can go to the butterfly, but, for one, that's very confusing, right? To me, anyway. Two, I like to just build it out. I like to look and say, okay, well, that's the 110 calls is my nearest to the at the money. So I'm going to sell that one, buy these twice, or screwing it up already, aren't I? Yeah, totally messed that one up. So I want to actually buy the 110, sell the two here, and then skip this strike to buy that one. All right, and that $10 wide to $20 wide does not work. So I might have to go a little bit closer, sell two of those. If I really thought it was going to be pretty neutral, it's still not going to work out. So I might even, no, I'm not going to be able to go wider than that. So it doesn't always work out. So make sure it does, because like I said, do not pay a debit for this if you've broken that wing, because you've increased your risk to one side. You have not eliminated your risk to the other side. So it's not worth doing it on a situation where you have risk on both sides. Don't increase your risk. Maybe just do the regular butterfly or something, okay? Or no, actually don't do the regular butterfly. Do the the straddle or the strangle or something like that. Or the iron condor, something along those lines where you can still be market neutral in a sense and fit those rules. So always double check that. All right. Any other questions real quick? It's not too difficult. Just remember, you got major rules with this. Do not do this if it is a debit. Do not go on to another strategy with high probability of success. All right. If it works out and you can eliminate all your downside, then that works. But otherwise, don't do it. All right. When you have a minute, can you go over the calculations for the break even? Not that clear. Yes, there's only a break even to one side. Okay. Let's go back to it was Twillo that gave us a good example, right? So let's delete that one. So it's trading around 60. So I'm going to buy that one. And then I'm going to sell 2 of these and then buy that one. I'm doing it backwards. Sorry, you guys. I'm going to sell this one, buy 2 of these, and then skip a strike and sell that one for the credit. Sorry, guys. All right. So did I skip that? Yeah. So $5 wide and then $10 wide. All right. And for the break even. So the distance, the thing to think about, the reason why your break even is a little funky is because, and may have difficulty thinking about it that way, is what happened there? Why is that giving me, stock or something? Sorry guys. Let me get rid of that. It was giving me the old stuff. All right, so I want to sell, then buy 2 of those, skip, and then sell that. All right, so I've got the $5 wide, $10 wide, so that's the skip strike. Then let's go down and look at it from a one lot so we can see the profit and loss real easy. Go to the Analyze tab. Why is that doing that, you guys? Anybody see what I'm doing wrong? 65, 75. Why is that giving me something funky? Oh, I'm doing it backwards. Oh, am I setting up my own strategy wrong, you guys? Is that what you're telling me? Yes, buy, sell, skip, buy. There. That's why I kept trying to get it to give me a credit, and I was forcing myself into doing the math backwards. All right, so skip strike. So we might have to go in the money here. So let's buy, sell to, skip the strike, and buy. Sorry about confusing myself earlier there, guys. I hope I didn't lose anybody. So I'm getting a big credit here because I did too many. Buy, sell to, skip a strike, and buy. So it's still a 12-cent debit. Let's just go make it look like a credit so I can get this example done. All right, so on the Analyze tab, what you would do is the reason why this works out like the spread, because remember, when we're going up, because we bought this spread, this synthetic spread, the 65 all the way to the 70, we're going to be making money, right? So that's why our break even is this break even plus the credit. It's basically that skip strike plus the credit, because we're gaining money as it goes from 65 to 66 to 67 to 68 to 69 to 70. And then once it starts going up above that, we start losing a little bit of that, right? So that's why it's that skip strike plus the break even, because this call spread is going to be gaining money all the way up to that skip strike. Okay. All right. Does anybody else have any questions on that? this strategy, the way that I'm setting it up, because I'm going slightly higher on the 65 strike, that means I'm bullish, right? Because that 65 strike is higher than where the underlying is trading. It means I'm slightly bullish to get to my max profit. To me, that's giving me a little bit of wiggle room to the upside. And it sets it up the best that way. You can go slightly into the money with this strike here, the one that you're buying. But remember, it's going to make it a little bit more difficult. It's usually the at the money is the one that gives you the best bang for your buck. Okay. All right. I know a lot of you guys were asking about, I see a couple questions popping up. I'll try and get to those right after I get done with this. You guys were asking about option strategies for earnings. This is it. This is my favorite time of the year, is every quarter when we have these earnings coming out, because I love trading earnings. You're in and out of these so quick. But this is a course for 36 bucks. You guys should take advantage of it. I mean, if you guys have enjoyed my instruction at all, especially if you're one of my regulars, or if you've even been a trader for a long time and taken one little nugget away, you know that it's going to be able to pay off this $36, because I'm going to give you a nugget in each one of these on how to trade earnings, and you'll be able to make it up during earnings season, most likely. All right. The best way to become a better trader is constantly learn, which you guys have obviously done. But wouldn't you say that knowing how to create an option strategy by going online and just reading about it, or even just trading off technical analysis, isn't enough to build or create consistent winners? And what I'm trying to say basically is the way to get ahead in this game is to increase your probabilities and become more mechanical, which is how I teach, and how to build strategies, which no one else is going to teach you that way, to increase your probabilities of success. And I teach it that way. How to play the probabilities. I'm always looking at it. I'm not necessarily looking at, I'm bullish in this or otherwise. I'm looking how to stay mechanical and increase my probabilities. All right. So if you're using the right tools in the right situation, you're going to be more productive and be in the right state of mind, which will allow you to do more or put on more strategies and create more opportunities. That will build your confidence and ultimately get you ahead in this game. So that link, the link is in the chat window. I just sent it out to everybody. We've been communicating over here in the questions box. I just sent it out. This link is in the chat window. If you're watching this on tape delay, you're going to have to pause it and type this into your URL. But I just want to thank you guys all for participating in this. Later webinars, I'm going to be drilling down on different option components, trades I find, when and where I find them appropriate. Here's also the link again. Like I said, you can call us at 310-598-6677 or email us at trading@protraderstrategies.com. Let me try and get to a couple of those questions that came up real quick, and then see if we need to do anything. Yes, Roger, Charles, did you get that link there? In a regular butterfly from the second short strike to the out of the money long call, one would lose as you are selling the short strike and buying. That's where your spread is going to start, because your long spread is going to make up for that spread, right? Let me make sure I said that right. So this spread, right? So as we come up from where we currently are, the 60 is the long spread to the short strike here. That's where we're making our So I did say that wrong. You're right, John. Sorry, I'm having a brain cramp all over the place today. This spread, as it increases in value to the 65, will pay off all of that to the break even. Does that make sense? This $3 spread increasing in value, we've made that $3 to the 65. So the 66 to 67 to the 70, this spread has paid for this loss to there, right? All right. So William, I hope I didn't confuse anybody there. Okay. And Adam, I'll try and read that here in a second. All right. So that's the idea, is eliminate the downside. We're buying an at the money, selling to just out of the money, and then we skip that equal distance strike to double it. All right. Great. All right. And the link works? Good. All right. Cool. All right. That's about it, you guys. Like I said, that link's in the chat window. Here is, there's a strategy. You know, I got short call spreads, short put spreads. There's probably 8 to 10 hours of videos with the earnings webinar here. Okay. There's about 8 to 10 videos here, all about the earnings trades. Okay. And how to trade those. All right, guys, that's all I got. If you can't take that, take it easy. Take care.